Hello everyone, how's it going? In this video, we're going to talk about Bionano Genomics, trading under the ticker symbol Bngo. Before the video begins, a quick heads up that not all my videos are made on the same day they're posted. If there are material events happening afterwards, I'm going to make a follow-up video to reflect those facts as well. With that being said, let's go on to today's topic. Bionano Genomics is a startup operating in the genomic sector and has been a popular stock to pick and a good topic of conversation amongst traders ever since late 2020, after the company managed to develop tests that are better and more affordable than its rivals. This was mentioned in the scientific magazines and picked up by ARK Invest on social media. This was a really major event for the stock because before that it was a penny stock. And because it attracted a lot of the attention of the retail traders, its appeal also showed up, which is the fact that Bionano Genomics seems to have a lead in the sector, and the sector itself is considered to be on the road of becoming a lot more significant in the years to come. The trading volume of Bionano Genomics recently reached around 6.2 million shares, compared to an average volume of 9.3 million shares. Over the past 52 weeks, its price fluctuated between $1.81 and $15.69. The market cap of Bionano Genomics is currently at $616 million, compared to an enterprise value of $1.2 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company, based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may be uncertain about the company's capacity to pay back the interest and principals. Of course, sometimes it may just be because a lot of people are shorting the stock, right? In either case, it can impact its profitability, attractiveness, and solvency, which in turn may impact the market cap. One key element to note is that the enterprise value is, for many companies, a little bit inflated, because one of the most significant assets they own is called goodwill. At least that's the case for many companies. Goodwill is an expectation from the market that this one particular company can do better than other competitors, because it can generate more profit or to grow more rapidly than other companies, with a better management team, more financial backers, stronger brand recognition, bigger online following, and so on. So it's basically what makes Bionano Genomics unique in the eyes of the investors compared to other genomics companies. In other words, it's not a tangible asset companies can use, but it's often the reason why companies are perceived to be trading at a discount. The market cap is lower than the enterprise value because the enterprise value includes the amount allocated to the goodwill. If the company goes to liquidation, there won't be any goodwill left, and the debt holders and shareholders would be left with potentially less assets to distribute amongst themselves than the figure currently on the balance sheet. In comparison to its historical price fluctuations, the stock is 21.5% higher than the 1-month low, 3-month low, and 52-week low. On the options market, which often gives a hint on the market sentiment on where the stock price is going to go, the implied volatility is 114% compared to a historical volatility of 83.4%. The put-call volume ratio is currently at 0.3, and keep in mind that it's normal for most stocks to tend to have a higher put option volume than what they deserve, because many institutional investors, when they invest, they systematically buy put options to hedge their risk. The most recent volume has been 3.6 thousand options contracts in a day, compared to the 30-day average of 4,000. Regarding the open interest, it has been 117,000 contracts compared to the 30-day average of 124,000 contracts. Regarding the shareholder structure, institutional shareholders own about 27% of all outstanding float. The biggest shareholders include Vanguard, iShares, and BlackRock. Understanding shareholder structure is relevant to an extent because it helps to determine if you should be holding the stock long term or to view it as a short term volatility play. If the stock is mainly held by retail traders, then it can be a sign that the stock lacks the depth to justify long term trust from shareholders. Usually, the consensus is that in order to stay long term in a stock, we gotta see at least 25 to 30% of institutional participation. Some exceptions also apply since many titles are excellent companies and held mostly by retail traders as well. But that so far is the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes there are significant short interest in the total volume. This can be a sign that there's an organized operation going on. Let's also take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. Oscillators are showing 0 sell, 9 neutral, and 2 buy, with an overall tendency of buy. Moving averages show 11 sells, 1 neutral, and 3 buys, with an overall tendency of strong sell. Keep in mind that indicators show the present and the past, but rarely predicts accurately the future. Nevertheless, they can be relevant to determine if your timing is the right one. Regarding the pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $1.82, $1.95, and $2.09. For the resistance levels, they are $2.35, $3.88, and $4.50. During the trading session on Monday, the stock initially went up to $2.15, around $2.30 or so, held that level for a few hours before retracing back all the way back to $2.16. The rest of the session was an effort for the stock to recover some of its losses during the day, but ultimately, Bionano Genomics closed at around $2.20, which is relatively normal for the stock if we look at the price actions over the past few months. From where we stand now, we cannot say for sure that the sell-off has necessarily ended because this is a long, very long sell-off, or if the stock is going to take off from there. There is no indication or no obvious support line to appear, and it has to be something that can hold up for more than a week before this assessment is changed. My opinion on the company is that it's worth your time to look into it. It's a company on the cutting edge of technology and may have a great future ahead of it. I would suggest to put it on your watch list and eventually in your portfolio, depending on your risk tolerance. Right now, there is a fair amount of capital still flowing around looking for the perfect time to come back to the growth stocks, and Bionano Genomics has been one of the more iconic titles in that sector over the past few years. Of course, keep in mind that the risk profile of Bionano Genomics is higher than most other blue chip titles and even higher than some of the growth stocks. So definitely keep that in mind as you buy Bngo, if you decide to do so. And my recommendation is to make sure that your exposure in Bngo remains at a maximum of 1% of your portfolio, and to buy in small batches once we spot a solid support line. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.